Welcome to Talk Tickers. Today, we are breaking down Granite Point Mortgage Trust's third quarter 2025 earnings results.
All right, so here's the game plan. We're going to hit the top-line numbers, then really unpack the big story this quarter, which is all about de-risking. After that, we'll check out management's timeline for the future, and we'll wrap it all up with our official take on the stock.
All right, let's jump right in. The headline numbers for Q3, well, they were a pretty big surprise, and in a good way.
So, first up, let's talk about core distributable earnings. This is a really key metric that all the analysts are watching. And get this, the consensus was for a 33-cent loss. But Granite Point, they came in and delivered a 2-cent profit. I mean, that's a huge beat, a 35-cent swing to the upside. Just a massive surprise.
And it wasn't just on earnings. The revenue story was just as strong. The street was looking for about $9.4 million. GPMT came in at $13.9 million. That's a beat of nearly 50%. So a really solid top-line performance.
So, no surprise, right? The market liked what it saw. The stock shot up almost 4% on the day of the earnings call. And look at that volume. It was trading at more than 5 times its recent average. A lot of eyeballs on this one.
Okay, so this is the big question, isn't it? The numbers look great, the market reacted well, so why is this stock still trading at such a massive discount? I mean, a huge discount to its peers and to what its assets are actually worth. To figure that out, we got to peel back the onion a bit and look past those headline numbers.
And here's the answer. The real story this quarter, the thing that explains everything else, it isn't about growth. Not at all. It's all about a strategic cleanup. They're basically cleaning house before they even think about building anything new.
Yeah, you could really boil down management's entire philosophy right now to this one simple phrase. They are laser-focused on resolving credit issues and protecting their book value. Growing earnings right now, that's taking a back seat. It's all about stability first.
And this isn't just talk. You can see it in the numbers. They're actively shrinking their loan portfolio. That's down over $380 million year to date. They're using that to chop down their total debt. They're finally getting some of these problem loans off the books, like a student housing property and a tricky Chicago office loan. Heck, they're even negotiating better borrowing rates to lower their costs. Every single one of these moves is about building a much stronger foundation.
Now, this slide here, this really paints the picture of the turnaround in credit. Think about it like this. All through last year, they were basically bracing for a storm, right? They were setting aside huge chunks of cash, about $164 million, to cover expected loan losses. But now, this quarter, they actually recorded a net benefit. That means the storm clouds are clearing and they feel confident enough to take a little bit of that cash back. It's a really positive signal that the worst might just be behind them.
Okay, so the big cleanup is happening. That's clear. The next logical question is, when do they get back to growing the business? Well, management gave us a pretty clear, if maybe a little cautious timeline. And they were really direct about this. Don't expect any new lending, any growth in that loan book until the middle of 2026. The next, 6 to 9 months are still all about this de-risking phase. They're working through problem loans and paying down debt. They did mention that repayments have been a bit slower than they'd like, so they're being patient.
So while all this is going on, there's one number you absolutely have to keep your eye on. Book value per share. Right now, it's at $7.94. And what is that? It's basically what the company would be worth on paper if they sold everything and paid off all their debts divided by the number of shares. The entire point of this whole de-risking strategy is to protect that number, to put a floor under it and stop it from going down.
Okay, let's bring it all together. What does this mean for the stock? This is where we get to the core investment debate, our final analysis.
This chart really lays bare the huge disconnect. Remember that book value we just talked about? $7.94? Well, the stock is trading around $2.70. That means the market is valuing this company at what? About 30 cents on the dollar for its assets? That's wild. It tells you the market is pricing in one of two things. Either a lot more pain to come or just a recovery that's going to take forever.
So you've really got two ways to look at this. The bull case is simple. This is a deep value play. The credit picture is getting better, they have plenty of cash, and that huge discount to book value gives you a massive margin of safety if they pull off this turnaround. The bear case, it's a classic value trap. Growth is way off in the distance, and if the economy takes a nosedive, new problems could pop up and delay everything. So, what's our verdict? We think the progress they're making is real and tangible. The most likely path forward seems to be a slow, steady operational improvement.
And that brings us to our official call.
We're rating Granite Point a market perform. We definitely see a path for the stock to climb into that 3 to 325 range over the next year as they keep cleaning house. But that lack of growth is going to be an anchor, and it'll probably keep the stock from outperforming the rest of the sector. So what are we watching for next quarter? It's all about their last 3 risk-rated 5 loans. These are the big problem children left on the books, and seeing them get resolved will be a huge milestone.
This is not financial advice.